Next guest says it will be difficult to cut interest rates with the economy heating up and inflation close to 3%. He's only expecting one cut in 2026. Joining now is Torsten Slok, chief economist at Apollo Global Management. Torsten, just one.
Well, the issue is that the winds are really changing for the U.S. economy. Last year, in 2025, there were a number of headwinds, most importantly, of course, the trade war. That's now fading more into the background. And instead, the one big beautiful bill, the Congressional Budget Office is saying that will add 0.9 percentage points to GDP. Remember, GDP normally grows at 2. So that's a very meaningful tailwind also coming to the economy in 2026. Combined together with oil prices going down, the dollar has gone down, and we still have relatively easy financial conditions. It is, in my view, looking like more that the tailwinds are beginning to accumulate and making it more difficult for the Fed to cut rates this year.
So we need bad labor market news.
Well, and that's why the discussion around the labor market is so important, because is the weakness that we have seen in the employment report, especially, of course, in the establishment survey, is the weakness driven mainly by weaker labor demand, or is it simply just slower data because of weaker labor supply? In other words, immigration has been slowing down dramatically. The CBO is estimating that immigration, which over the last several years was around 3 million, is now going to slow to around 500,000 a year for the next 2 years. So therefore, if you simply have a weaker labor market, it may not mean that this is weaker labor demand. It may mean that there's just a slowdown simply because of less immigration. So that's why there's a huge discrepancy between what the labor market data is telling us relative to what the GDP accounts are telling us.
Torsten, disabuse me of the following pessimistic scenario. Okay, are you ready? One is that we've only had like a half a year of tariffs, not even at the full rate. Two is that companies don't shut down immediately. They more wither away than they do close immediately, which is to say we have not yet seen the negative effects of a 15% increase or so on our imports of tariffs. And three, am I on 3 or 4 now, John?
Three,
thank you, sir. Three is that the AI investment boom is covering up this weakness in the manufacturing sector and other parts of the economy, that if you took that away, what's underneath it is pretty weak.
And that is to some degree correct. A very significant share of growth in 2025 was indeed the AI data center build-out and associated energy build-out. So indeed, if it is the case that the AI story begins to roll over, and this could be as simple as the Magnificent Seven simply have weaker earnings. It could also be discussions around that maybe we are converging towards one large language model. So if that were to happen, then we would begin to see some more weakness, and they would indeed begin, as you're saying, Steve, to reveal that some other parts of the economy, the manufacturing sector in particular, manufacturing employment and also the ISM has been weak now for the last 9-10 months. So you're right that there is quite a discrepancy. It's not only a K-shaped economy for the consumer, where some consumers are doing well and others are not doing well. It is exactly also a K-shaped outlook for the corporates, where you have some corporates doing well.
Manufacturing has lost 59,000 jobs so far this year, and small businesses in the ADP data, size 1 to 49 employees, have lost 250,000 jobs since Liberation Day. So I'm not saying I agree with that scenario, and I like Torsten's outlook much better. I'm just saying there's some other data that points to a kind of weakness underneath what's happening at the top.